I think one lesson that was pretty quickly taught in 2023 is that diversified investing isn't dead. You may recall at the end of 2022, we had an uncommon period where both stocks and bonds declined at the same time. And we haven't seen that, and certainly at that magnitude for quite a while. And so you see the headlines, diversification is dead, often written by somebody who has an expensive idea to offer you that's better than diversification. 2023 turned into a pretty good year, kicked off just fine with stocks and bonds. It's not that they're broken, and that's often the case. A lot of times the strongest stock returns are after periods of stock decline, and when bonds go down, that means they have higher yields, and so they can pay off faster as well. Looking forward at 2024, we may ask, how are things different, or what does this inform us about the future for markets? And probably the tidiest way we could map that up is on the bond side. Bonds returns are just more mathematical. Periods of higher yields precede higher total returns for bonds, and yields are higher throughout the bond world. On the stock side, it's not quite as tidy. You have how expensive stocks are, what the growth rates will be, what happens with dividends. So it's more variable, especially over the short run. So these types of metrics, you can't say that makes us more excited for a 1-year or a 2-year forecast. Not reliable. However, stocks aren't quite as expensive as what they were, and that is a pretty good predictor of whether long-run returns will be above or below average. And so with stocks not being as expensive as what they were, we're just a little bit more optimistic on what stocks will provide for investors the 10 years that follow to the beginning of 2024.